Meet Mr. Market, the unpredictable and moody character who embodies the emotional roller coaster of the stock market. This fictional persona, created by legendary investor Benjamin Graham, serves as a powerful metaphor to help investors navigate the often turbulent waters of financial markets. Imagine you own a small business with a partner named Mr. Market. Every day, he approaches you with an offer to either buy your share of the business or sell you his. The catch? Mr. Market suffers from extreme mood swings. Some days, he's bursting with optimism, quoting ridiculously high prices for the business. Other days, he's consumed by pessimism, willing to sell his share for a fraction of its worth. This is exactly how the stock market behaves. It swings wildly between euphoria and despair, often divorced from the actual value of the underlying businesses. Understanding this concept can be a game changer for investors, helping them avoid costly mistakes and capitalize on opportunities. Let's dive deeper into Mr. Market's personality. He's emotional, irrational, and prone to overreaction. When things are going well, he becomes overly excited, bidding up prices to unsustainable levels. During tough times, he panics, selling stocks at fire sale prices. The key lesson here is that as an investor, you don't have to play Mr. Market's game. You're free to ignore his daily mood swings and wait for those rare moments when his offer aligns with your assessment of a company's true value. Consider the dot-com bubble of the late 1990s. Mr. Market was in a manic phase, assigning astronomical valuations to tech companies with little to no profits. Many investors got caught up in the frenzy, buying overpriced stocks at the peak. When the bubble burst, Mr. Market swung to extreme pessimism, and those same investors sold in a panic, locking in huge losses. A savvy investor who understood Mr. Market's nature would have resisted the urge to buy during the bubble and instead waited for the inevitable crash to pick up quality companies at bargain prices. But how can you, as an individual investor, apply this wisdom to your own strategy? First, it's crucial to develop a clear understanding of a company's intrinsic value before even considering Mr. Market's offers. Once you have a solid grasp of a company's value, you can use Mr. Market's mood swings to your advantage. When he's overly pessimistic and offering stocks at a significant discount to their intrinsic value, it might be time to buy. Conversely, when he's irrationally exuberant and bidding up prices beyond reason, it could be an opportunity to sell or at least avoid buying. Remember, Mr. Market's daily quotes are just that, offers. You're under no obligation to act on them. Patience is your greatest ally when dealing with Mr. Market. Let's look at a real-world example to illustrate this point. During the 2008 financial crisis, Mr. Market was in full panic mode. He was offering shares of solid companies at pennies on the dollar. Investors who understood the temporary nature of Mr. Market's moods saw this as a once-in-a-generation buying opportunity. One of the challenges in dealing with Mr. Market is that his mood can be contagious. When everyone around you is excited about a hot new stock or terrified of a market crash, it's hard not to get swept up in the emotion. Developing this emotional discipline takes time and practice. Start by paying attention to your own reactions to market movements. Next, try to cultivate a contrarian mindset. When Mr. Market is at his most pessimistic, train yourself to look for opportunities. It's also helpful to have a long-term perspective. Mr. Market's daily mood swings become less significant when you're focused on the performance of a business over years or decades rather than days or weeks. Another practical tip is to limit your exposure to daily market news and commentary. While staying informed is important, constant exposure to market updates can make it harder to maintain your emotional equilibrium. Remember, Mr. Market is there to serve you, not to guide you. His mood swings create opportunities for the disciplined investor. Ultimately, success in investing isn't about outsmarting Mr. Market on a daily basis. It's about understanding his nature and using that knowledge to make rational, long-term decisions.